Good day everyone, my name is Igbinoba Obeyomena and I'll be your e-tutor for ACC 121. In today's study session, which marks the beginning of the study session, we'll be talking about basic concepts of bookkeeping. Now, at the end of the learning of this study session 1, you are supposed to learn some basic things, which includes 1, you're supposed to be able to define and use correctly all the keywords printed in bold, explain the concepts of bookkeeping, explain the differences between bookkeeping and accounting, and also differentiate between source documents and subsidiary books. Introduction. In this session, you will learn more about bookkeeping as it forms an essential part of accounting. The bookkeeper is one who basically records information first once they occur, so that the accountant will have things to work upon. They are actually evidences that substantiates whatsoever information will be recorded in the financial statement. The purpose of this is to determine the profit or the loss that any business will make at the end of the accounting period. We will also look at the differences between bookkeeping and accounting and review various books that are kept by the bookkeeper. Concept of bookkeeping. First, we would like to look at a source document. A source document is the original record containing the details to substantiate a transaction entered in an accounting system. A source document can be a receipt, can be an invoice, it could also be a debit note. These source documents form the basis for entry into the books called original entry. By way of recapping, source documents are documents that provide evidence. They provide evidence for every transaction that is recorded in the accounting system. Now we'll go to books of original entry. Books of original entry refers to the accounting journal in which business transactions are initially recorded. As the name implies, they are the place or the first point of contact where we record transactions. The information in these books are then summarized and posted into ledgers. From the ledgers, we then produce the financial statements. As we know, books of original entry are books in which we record the transactions. These specialized journal or day books are called books of original entry. Thus, we have separate books for each kind of transaction. For example, if we want to record sales of goods, we have to record that in the sales journal or in the sales day book. We do not have to be confused about these terms because they could be used interchangeably. That is the sales journal or the sales day book. So whenever you hear either of these terms, know that they mean the same thing. Now we have the purchase journal or the purchase day book. The purchase journal is used to record the entries or transactions for credit purchases. Purchases journal is only used to record entries that are credit in nature. We do not record cash transactions in this book. So a purchase journal as well as a sales journal or a sales purchase day book is used to record credit transactions. Now we'll look at sales return journal or sales return day book. When a business makes sales to customers, it's possible that the customer may want to return some of those goods for various reasons. It could be as a result of defects in the goods, or perhaps they are substandard or expired. So when this customer returns these goods back after we've sold them, this is the place where we actually record this kind of transactions, that is the sales returns journal. Sales returns journal is used to record the entries or transactions for sales returns and is also known as returns inwards. Like the name implies, the goods are coming back to us, so we call it sales return inwards. Now for this, there's a very simple accounting entry that we have to perform. we have to debit the sales return or return inwards and credit the debtor, that is the receivable as it's called now, that is the customer in question. Why are we crediting it? Initially, this person has a debit entry, and for us to reduce their indebtedness to the company, we have to credit them, and the other corresponding entry will be to debit the sales return or the return inwards book. Now we go to the purchase return journal or purchase return day book. On the other hand, when we purchase goods from outsiders for us to resell them, or for us to for them to serve as raw materials for us to make other finished products, it is likely that some of these goods might be defective, and as such you may want to return them back to the suppliers. When we return goods to the suppliers, we record this in the purchase returns journal. Purchase return journal is used to capture goods that we take out of our business which we initially purchased. So we can also call them return outwards. The accounting entry for this is to debit the creditor and to credit the purchases return or the return outward. When we debit the creditor, it actually reduces what we are owing them. And if you look at your modules, you see a format of what it looks like. You see that it has a date, a colon for debit note, then the particulars is the information or the details that you are recording, the folio, then the amount. Now we'll go to double entry system. In accounting, we have the dual aspect that is concerned with the demands of every transaction. When you hear double entry, what comes to our mind is the dual aspect concept, which says that for a giver, there must be a receiver. In simple terms, for every transaction, there must be at least two parties involved. One is the one that is giving value, and the other party is the one that is receiving value. Thus, the double entry principle, like we have learned before, is actually postulated by Luca Pacioli in the year 1494 in his book, where he stated that for every debit entry there must be a corresponding credit entry and vice versa. In simple terms, debit the receiver, the person gaining value, and credit the giver, the person that is actually giving the value to the other party. Transactions are posted to the ledger in line with the double entry principle. A ledger is a book that contains all the accounts of the transaction of a business entity. An account, on the other hand, is a page in the ledger that is divided into two equal halves, vertically, and then a horizontal line on the top. However, accounts and ledger are sometimes used interchangeably to mean the same thing. A ledger is a book that contains the accounts for the transaction of a business entity. It is written periodically as deemed fit by the business, and it's also known as the main book or the principal book of accounts. We have basically three types of ledger. The first is the sales ledger, followed by the purchases ledger, then the general ledger. The sales ledger, like the name implies, is a set of books in which personal accounts of credit customers are kept. A credit customer is also known as a debtor. It means that the persons that are owing you, they are the person's information that we are going to record in the sales ledger. A balance of the customer's account shows the amount that customers are owing to the business at a particular period of time. Therefore, the total of these balances in the sales ledger is the total amount that is owed by its credit customers. This amount at the end of the financial period is transferred to the statement of financial position, and it is represented as trade receivables there. Purchases ledger, on the other hand, is a personal record of accounts of credit suppliers. In this place, we keep records of those that have supplied our business goods and we are yet to make payments to them. A credit supplier is also called a creditor or a trade payable. The balance on this account shows the amount that the business is owing to all of its suppliers at the end of a financial period. This amount is called trade payables or accounts payables, and this figure is represented in the statement of financial position as a current liability. Now we'll move to the cash book. The cash book is a subsidiary book and also a ledger that records all cash transactions of a business organization over a period of time. The cash book can either be a single column cash book, a 2-column cash book also known as a double column cash book, or a 3-column cash book. For a single column cash book, it records only transactions that we use physical cash for. While for a double column cash book, it records both cash transactions and transactions that requires the use of check. So in this case, we have separate columns for both cash and bank. But for the single column cash book, we just have a single column for cash. That means all the transactions there are done on cash basis. For a 3-column cash book, the difference is that we have a 3rd column for discount allowed and for discount received. When we go out to purchase goods, we might be allowed some form of discount, and so we're receiving that discount. So on the purchases side, we have something we call discount received that serves as a rebate to us. Also, when customers come to buy from us, when we sell to them, we can also allow discounts to them. So discount allowed is to sales, while discount received is to purchases. In summary, in this study session, we have learned what a source document is. We have said that it's an original record containing the details that serves as an evidence to a transaction entered into the accounting system. And we gave instances or examples of some source documents, which includes sales invoice, receipt, credit notes, and debit notes. We've also learned that most big companies that record their business in one journal and post it to another ledger might find it difficult if they do not undergo this bookkeeping process, which requires a more clerical labor to engage in. To avoid such kinds of difficulties by these organizations, they subdivide the journals into subsidiary books or subsidiary journals. These books are also called books of original entry, in which similar nature of transactions are recorded in a chronological order. Bookkeeping can be thought of as the financial information infrastructure of an entity, like we have earlier illustrated from today's discourse. The financial information base should be complete, accurate, and timely for it to be relevant. Now we'll go to the self-assessment questions. At the end of this module, you are to assess to know if you have actually achieved the learning outcomes by answering the following questions. You can write your answers in a study diary and discuss them with your tutor at the next support meeting. You can check your answers also with the notes on the self-assessment questions at the end of this module. First, you should be able to explain what the books of original entry mean. Number 2, explain the following and what they are used for: the date column, the invoice column, the customer column, the folio column, and the amount column. Also, you should be able to explain the following: the sales ledger, purchases ledger, and the cash book. Thank you for your time.